What does a company with $200 billion in cash do? Well, maybe spend it on content for its upcoming streaming service. While the company has not disclosed how much it has spent on Apple TV+, it could be in a position that current streaming service, Netflix, might describe as enviable. Joining me to discuss from Stamford, Connecticut, senior research analyst of D.A. Davidson, Tom Forte. He currently has a buy rating on Apple. Tom, broadly here, as you analyze the streaming service, do you expect Apple to outspend its competitors?
So I definitely think Apple has the potential to outspend. As you pointed out, they have a massive treasure chest. But the way that we've been talking about it is the speculation is they're spending $6 billion, up from the original expectation of $1 billion. And for Apple, that kind of puts premium content spending as more of a serious hobby and not really a job yet for the company. So I do think they have the potential to spend a lot more, but so far they haven't really shown that.
And put that $6 billion into perspective. What are some of the other competitors that you follow spending if Apple really is spending $6 billion?
So by way of comparison, Netflix, the market leader today, is in the $10 billion plus range. So $6 billion versus $10 billion is certainly a significant figure, but it's still lower than what Netflix is spending. And again, they have the potential to spend a lot more, but so far they haven't shown the propensity to do so.
Tom, I want to show a chart to our Bloomberg audience, and it's in my terminal here at GTV Go. And basically, we're just looking at net cash, which is cash of $200 billion on the balance sheet, minus debt of $108 billion. So you're still looking at net cash of more than $100 billion. Would you argue that Apple's balance sheet is in the best shape to be spending this cash?
So the answer is absolutely. So not that long ago, we used to joke that it was a great time to be a B-list actor with all the streaming video services that were coming online. The difference with Apple involved is now it's good time to be an A-list actor. If you think of Jennifer Aniston, if you think of the other A-list talent they're employing, Oprah Winfrey, Steven Spielberg. So Apple certainly has the checkbook to write some massive checks if it wants to pursue that opportunity even more so.
And then, Tom, as we take a look at balance sheet dynamics, you look at $200 billion in cash, and then you have a $65 billion free cash flow. We've all heard the story from Netflix of negative free cash flow and burning the money. How does free cash flow factor into your analysis here?
Yeah, so basically, the free cash flow that Apple generates, not that long ago, when Netflix was a smaller market cap, in a good quarter, Apple could have bought Netflix. So the beauty of Apple's business model, as primarily focusing on the high-margin products within a category, you think of them selling the most profitable smartphones as an example, enables Apple to generate tremendous free cash flow. And that free cash flow, coupled with their balance sheet, gives Apple a lot of dry powder, which they could use to go after premium content even more significantly.
Well, and Tom, I remember Apple had gotten a little bit of pushback from investors, from people on the street who were saying you're hoarding your cash, spend it, do a buyback, do a dividend. And Apple sort of stood its ground and said, we're going to keep our cash. Are we sort of laughing now as Apple now has rightfully so sort of built up this cash hoard for this rainy day?
So the good news is that Apple does return a large amount of cash flow to shareholders via buybacks and dividends. But more importantly, if you step back for a minute, what's most important to Apple right now is diversifying away from its overdependence on one product, being the smartphone, which was north of 60% of their sales in the last fiscal year. And if you look at their efforts in not only proprietary content, but also financial services, including payments and healthcare, then that large cash balance certainly gives the company a lot of money to invest in things that aren't directly related to smartphones, which is really good news for Apple and for Apple shareholders right now.
Well, and Tom, we have another chart here that I'm showing of Apple's reliance on that iPhone. And of course, as they raise the prices on those iPhones, you've started to see it slip. But this fits into that broader narrative, as you've been talking about, that Apple is a services company. It's trying to transition away from that iPhone. How do you see Apple TV play into the broader narrative that is really the future of Apple? Where does it fit into their strategy?
So definitely when I think about their pre-announcement, which was a huge shock last year on weaker than expected iPhone sales in the December quarter, I think what that did is reset the bar. And that to the company's credit, it's been able to change the narrative, and investors are soaking up this narrative and reacting to it favorably. And it's the company's efforts to diversify away from their overdependence on the smartphone. Proprietary content is definitely part of that, along with financial services. You think of not only Apple Payments, but the Apple credit card, and then all the things they're doing in healthcare.